Okay, welcome back everyone. As I mentioned in the last episode, the important thing when you are investing long-term in the stock market is not primarily what kind of stocks you choose or what stock you choose. The important thing is how many you have of each. And I'm gonna tell you a little bit about modern portfolio theory, which is the main theory being used by companies investing in the stock market long term. And it basically works like this. Take this example. We have three companies: an energy company, a phone company, and a steel company. And we have put 1/3 of our money in each. And as we can see, the returns is the same. So each year you will get 10% returns from each of these companies. That means that the combined portfolio will also get 10% because all of these is the same. No matter how you distribute between them, they will always give 10%. Okay, so now we come to this topic of risk. Let's, for sake of argument, say that the energy company has a 5% risk, the phone company has a 10% risk, and the steel company has a 15% risk. So same returns, but different risk. So if we have 1/3 of our money, we will end up with something like around 10% portfolio risk. Okay, so that's not very interesting. It's just the middle value of this one. But what if we were to do like this? If we have 0%, 0%, and we have 100%, then all the risk will come from this stock, and we would have 5% risk. Okay, but the interesting part is you can optimize this distribution so you get the same returns, or basically the same returns, but lower risk, lower than the lowest of the individual stock. So let's say that distribution is something like 23%, and let's say 61, let's say 16. So if we do this distribution, then we might end up with still 10% portfolio returns, but we'll end up with perhaps 3.5% risk. And that is what is really interesting with this, that you can optimize the distribution among your stock. So you get the same returns, or perhaps even better, but same or maybe a little worse, but much lower risk. And this is by 3 stock. If we were to have the optimal amount, which is 30 or so, 30 different stock, then we might get this to as low as 2%. So less than half of this. And that's basically because of what I told you before, that all the different stock in your portfolio have a relationship to each other. When one of them moves in either direction, the other one moves accordingly. Not the same, but in the same kind of way, but less or more. So if you have a lot of stock, 30 or more, then you get approximately half of the risk. So that's what this course is about. You will learn step by step how to, no matter how you choose your different stock, you will learn how to calculate these values so you optimize it and get the best possible portfolio returns, but with the lowest possible risk. And that will make a huge difference in the long run. I can take one example. About a year ago, I did an experiment. I bought, I think, 20 or 25 American stock from the S&P 500 list, and I choose them randomly. The only thing I checked for was that it wasn't an internet company, because the internet companies were doing very bad at the time. So other than that, I chose 25 stock at random. And I'm recording this in June of 2023. So in the last year, there has been the biggest inflation in the last 25 years and the highest interest rates in the last 25 years. Both of this is extremely unfortunate for the stock market. And in addition to this, for the last year, a war has been raging in Europe. And even though all of these factors, randomized stocks, and war in Europe, high inflation, and high interest rates. And still, because of me using the modern portfolio theory to calculate the distribution, and me not trading anything but keeping the stocks for a year, I still made a 5% gain during that time period. So this is how powerful this is. If it is a regular year with normal interest rates and normal 2% inflation and no war in Europe, then you can make a lot of money this way. So keep on watching this series and you will learn step by step how to use this technique. And you don't even need to be good at calculating stuff and be good at math and so on. And you don't have to know Excel, because I will show you step by step how to do it, and you just do it the same way but with your stock. Thanks for watching and thanks for today.